In the vast ocean of financial information, where fleeting trends and speculative bubbles constantly vie for our attention, it's easy to feel adrift. The promise of doubling your portfolio, a siren song sung by many, often leads us down paths of chasing the next hot stock, the latest market darling. But what if the real secret to substantial, sustainable growth isn't found in prediction, but in diligent, almost sacred analysis? What if the true engine of wealth accumulation lies not in the ephemeral whispers of the market, but in the enduring principles laid down by giants like Benjamin Graham, the very architect of value investing? This journey we embark on today is not about the illusion of quick riches, nor is it about deciphering cryptic market forecasts. Instead, we will peel back the layers of hype and speculation to uncover the bedrock of intelligent investing. We will explore the fundamental truths that have guided Warren Buffett, a student of Graham, to build a legacy of remarkable financial resilience. These are not fleeting tactics, but timeless pillars, the non-negotiable principles that form the very foundation of understanding what you truly own and why its intrinsic worth far surpasses its current market price. Prepare to recalibrate your compass. We are shifting from the precarious stance of market speculation to the solid ground of intelligent ownership. This is more than just advice. It is a roadmap, a distillation of wisdom designed to help you not just navigate, but truly grow your portfolio, doubling its potential not through luck or chance, but through the unwavering application of logic and deep understanding. This is your guide to building a financial fortress, brick by analyzed brick. The first pillar of value investing is akin to donning the lens of the truly intelligent investor, stepping beyond the fleeting dance of the stock price to uncover the unshakable truth of intrinsic value. The market price, you see, is a mercurial observer, buffeted by daily winds of sentiment and speculation. Intrinsic value, however, is the enduring reality, the fundamental worth of a business, independent of the market's mood. Benjamin Graham, the master himself, taught us to look past the ticker symbol and assess a company's true substance. He provided foundational concepts like net current asset value, a measure of a company's tangible assets minus its liabilities, and earnings power value, which focuses on the sustainable profitability a business can generate. Consider it like valuing a beloved home. We wouldn't base its worth solely on what it might fetch on a particularly frantic auction day. Instead, we assess its solid construction, its potential for generating rental income, the enduring desirability of its location. We apply this same logic to businesses, examining their earnings, their underlying assets, and their realistic future prospects, not their daily fluctuations. The market, contrary to popular belief, is not always an efficient arbiter of value. Behavioral biases often create opportunities, moments where a diligent investor can, as Graham advocated, acquire a dollar's worth of assets for merely 50 cents. This is the essence of buying with a margin of safety. Our actionable step here is to begin the practice of calculating a simple intrinsic value range for a business. This requires delving into publicly available financial statements, analyzing its true earnings power and its asset base, and consciously setting aside the cacophony of short-term market noise. This pillar is about gaining clarity, about seeing the entire forest of a business's worth, not just individual trees that might be temporarily out of favor. As Graham wisely advised, the investor who buys stocks only when they are cheap is the one who will profit in the long run. We are providing you with the fundamental tools to identify that crucial cheapness in the often tumultuous landscape of financial markets, where unforeseen events and analytical missteps can emerge without warning. The concept of a margin of safety stands as your most crucial, non-negotiable insurance policy. This isn't merely a suggestion, it is the bedrock of prudent investing, a principle designed to shield your portfolio from the inevitable shocks and uncertainties that define market volatility. We will delve into quantifying this vital concept, illustrating precisely how purchasing assets at a significant discount to their carefully assessed intrinsic value acts as a powerful buffer, protecting you against both unforeseen economic downturns and your own potential analytical errors. Imagine the meticulous work of building a bridge. Engineers do not design it to precisely hold the maximum expected load. Instead, they construct it to withstand loads far exceeding that expected maximum. This deliberate buffer, this excess capacity, is your margin of safety. It is the engineered resilience that absorbs unexpected stresses, preventing catastrophic failure when the unexpected occurs. The allure of growth at any price often leads investors astray, blinding them to this essential buffer. When growth is chased without a margin of safety, portfolios become inherently vulnerable, exposed to the slightest tremor in the economic foundations. This approach, I must stress, is more akin to calculated gambling than disciplined investing. Our practical application here involves demonstrating how to calculate this margin of safety. It's a straightforward comparison. Your rigorously estimated intrinsic value versus the current market price. By setting clear buy targets that incorporate a substantial discount, you ensure fourth, that every investment decision is made with a built-in advantage, buying not at fair value, but at a bargain. Warren Buffett, a devoted student of Benjamin Graham, distilled this wisdom into two immortal rules. Rule no. 1. Never lose money. Rule no. 2. Never forget rule no. 1. The margin of safety is the practical, tangible embodiment of this profound advice. It is the mechanism that transforms inherent risk into a calculated opportunity, a shield that guards your capital while paving the way for substantial gains. The third fundamental pillar guiding us toward doubling our portfolio's growth is the principle of the circle of competence. In the relentless pursuit of financial mastery, the temptation to chase complex, often opaque, cutting-edge industries can be a powerful, yet perilous, siren song. It lures ambitious investors away from solid ground and into speculative waters. We must, therefore, explore why consistently investing within the boundaries of what you genuinely understand, your circle of competence, is not just beneficial, but utterly paramount for achieving sustained success. Consider the game of chess. Trying to win a match against a seasoned grandmother by making random, uninformed moves is a recipe for immediate defeat. Similarly, venturing into investment areas you don't fully grasp is akin to playing that game blindfolded. Value investing success within your circle of competence, however, is like playing chess where you intuitively understand every piece, every strategy, every potential outcome. Stepping outside these defined boundaries is where the true risk lies. Let us decisively debunk a pervasive myth. True sophistication in investing is not about possessing encyclopedic knowledge of every company or every industry. Rather, it is about the profound wisdom of understanding the precise boundaries of your own knowledge. It is about recognizing what you do not know, and having the discipline to steer clear of areas where your understanding is insufficient. This intellectual humility is not a weakness. It is, in fact, one of the most potent strengths an investor can possess. Our actionable insight here involves a clear, introspective step. Identify your current circle of competence. What industries, what business models, what unique competitive advantages do you truly grasp? We will provide a simple framework to help you assess these boundaries methodically. Expanding this circle should be a deliberate, gradual process built on a foundation of solid understanding, not on a sudden leap of faith. As Warren Buffett himself so eloquently stated, you don't have to be an expert on every company or even every industry. You do have to know the boundaries of your own knowledge and stay within them. This principle is the very bedrock of making informed, confident, and ultimately profitable investment decisions. The fourth, and perhaps most psychologically challenging, pillar for doubling your portfolio's growth is the cultivation of a long-term perspective. In an era defined by instant gratification and a relentless stream of immediate information, the temptation to react to every tick of the market clock is immense. Yet, the profound truth is that true, sustainable wealth is not conjured in days or weeks, but meticulously built over years, often decades. We will reveal how adopting this long-term viewpoint, much like the patient endeavor of planting a vast forest rather than a quick-growing, ephemeral weed, is the essential key to unlocking your portfolio's doubled potential. This is where the magic of compounding truly reveals itself. Often hailed as the eighth wonder of the world, this pillar is fundamentally about granting that wonder the time it so desperately needs to perform its alchemy. It represents the profound difference between a single, fleeting harvest and the enduring abundance derived from a lifetime of tending a well-established orchard. The growth you seek requires patience, allowing the seeds of your investments to mature into a rich, sustainable yield. We must confront the significant psychological trap that plagues so many investors, the constant barrage of breaking news and the seductive allure of short-term market predictions. This relentless noise actively fosters impatience, driving impulsive decisions and, more often than not, leading to the premature selling of sound investments. We will demonstrate precisely how this pervasive noise actively works against the very long-term growth you aim to achieve, and crucially, how to develop the mental fortitude to effectively tune it out. Our practical strategy for this pillar involves developing a clear investment time horizon and establishing a mental checklist for reviewing your holdings. The focus must unequivocally shift from the ephemeral daily stock price to the enduring performance of the underlying business itself. Resist with all your might the urge to time the market, as Benjamin Graham, a sage of investing, so deeply understood and articulated. The stock investor who thinks on your own and has the patience to wait for the right opportunity will often be rewarded. Patience, in this context, is not merely a passive virtue. It is an active, data-backed, and profoundly powerful strategy for doubling your returns over time. But we have now journeyed through the four foundational pillars that form the bedrock of value investing. The discerning pursuit of intrinsic value the unyielding shield of the margin of safety the disciplined adherence to your circle of competence and the patient embrace of the long-term perspective ***. Individually, each principle offers powerful guidance. Together, however, they interlock to create something far greater than the sum of their parts, a robust, integrated wealth-building engine designed for sustainable, compounding growth. Think of these 4 pillars as the essential legs supporting a sturdy table. Remove even one, and the entire structure becomes unstable, prone to wobbling under the slightest pressure, or even outright collapse. When held together in harmony, however, they form an unshakable framework capable of weathering the fiercest market storms and consistently delivering the compounding returns that are the hallmark of true value investing. Here lies a hidden truth that often eludes aspiring investors. Many dabble in one or perhaps 2 of these crucial principles, yet they fail to truly integrate all 4 into a cohesive strategy. This fragmented, incomplete approach is precisely why even seemingly intelligent investors can find themselves underperforming their potential. True value investing is not a collection of isolated tactics. It is a holistic, deeply integrated discipline. Our actionable roadmap forward is clear. Create your personal value investing checklist, one that rigorously integrates all 4 pillars. Before any investment decision is made, let these questions guide you. Do I genuinely understand this business and its underlying economics? Is it currently trading below its intrinsic value, offering a sufficient margin of safety? Does this opportunity reside comfortably within my defined circle of competence? And crucially, do I possess the conviction and the plan to hold this investment for the long term? As Warren Buffett wisely advises, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. By mastering and integrating these 4 pillars, you are not merely acquiring stocks. You are strategically purchasing businesses with a profound commitment to long-term, sustainable growth, the ultimate, proven path to doubling your portfolio. We have journeyed together, dissecting the 4 core principles that form the very soul of value investing. We've explored the unwavering pursuit of intrinsic value the essential shield of the margin of safety the disciplined wisdom of operating within your circle of competence and the profound power found in long-term perspective These are not abstract theories confined to dusty books. They are actionable blueprints, a practical guide designed to unlock significant, sustainable growth for your portfolio. Recall the timeless wisdom of Benjamin Graham, the father of this philosophy. The intelligent investor is a realist who sells to optimists and buys from pessimists. By diligently applying the principles we've discussed, you position yourself not to chase fleeting trends, but to consistently and profitably act as that informed realist. You learn to buy when others are driven by fear and to sell when exuberance takes hold, always guided by the underlying value of the asset. The path to doubling your portfolio's growth, as we've seen, is not paved with magic bullets or speculative shortcuts. It is meticulously constructed through the diligent and unwavering application of these time-tested fundamentals. It demands patience, a deep reservoir of discipline, and an unyielding commitment to truly understanding the businesses you choose to own. This is the essence of intelligent investing. For your immediate next step, consider this your homework. Choose one company that you genuinely understand, one whose business you can clearly articulate. Begin the process of calculating its intrinsic value range. Then, critically assess whether this company, at its current market price, offers a sufficient margin of safety, that crucial discount for a potential investment. This practical application is where understanding transforms into tangible progress. Ultimately, the true power to double your portfolio's growth resides not in the crystal ball of predicting the future, but in the profound act of understanding the present and acting upon that understanding with unwavering conviction. Embrace these principles, integrate them into your investment process, and you will find yourself not just on the path, but actively walking towards true financial mastery.